Today we finished a little bit lower on Wall Street as we wrapped up the month of August. And my oh my, what a stretch it's been. This is our 7th straight month of gains for the S&P 500. Obviously a pretty rare feat throughout history. So we'll take a look at how things wrapped up here today, see what it means for our posture. Then we'll get into our trade application example, where I wanted to focus on one of the indices that has been lagging in recent months for a rare bearish trade known as a bear call spread. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 31st, 2021. First of all, if you're new, welcome aboard. Remember to go over to our YouTube channel, click subscribe while you're there, then go down to our description area down below where you can sign up for our email distribution list. We're also heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at my handle @BrandonVanZ. And we really appreciate those of you that click like and retweet on these Market Outlook related tweets. And then last but not least, we do have a presence on Facebook. Feel free to join us at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. As you can see, I've got our heat map pulled up here to give us a general sense of things as far as winners and losers within what we call the Market Scholars 1000, which for those of you that are premium members, be aware that I made some pretty big changes to that over the weekend. You should have received my Telegram note about that. I think there were 53 swaps that I did out of those 1,000 stocks. So you can always access those watch lists on our website if you need to update your lists as well. But this gives us a pretty good overview, not just here in the United States, but what's happening worldwide with some of the more liquid securities out there. As you can see, we do have some large green squares in front of us, namely Alibaba, with about a 3% move here today out of China. Not to be outdone, Pinduoduo, which is also a huge company over in China, up about 5%. We had JD.com, which competes with Alibaba over there, up 2.4%. We also had NetEase, which is a Chinese internet gaming company, up about 8 or 9% today. And of course, that's been a little bit more in the news here recently as there's been some limitations towards household gaming in China. At least that's what the government will tell you. I guess they're going to limit it to 3 hours a week. So at first, people would have thought, well, that might make things a little bit more difficult for the gaming players, but some of it's already been baked into the cake because those stocks are down significantly since just this summer. So maybe a little bit of a snapback rally here today in some of those names, just to kind of cool things off a bit from the intense selling that they've had for many months at this point. We did see Baidu, another big Chinese internet company, up about 2.5% today as well. So a lot of those key green tags that you see there are from the Chinese players that had a nice snapback here today. In terms of who were the losers of today's session, I can see a couple of them that stand out. First of all, Zoom Video really bombed it when they reported their earnings here yesterday. You can see that stock was down 16% today. That's a nasty day. Obviously, that stock's up hundreds of percent over the last few years as it's kind of the quintessential coronavirus play. But as we kind of go back to a more normal society where kids are back in school in person and doing less Zoom videos out there, that stock really got crunched here today. Also, Wells Fargo took a hit here today. It was down about 5.6%. That's an above average day for Wells Fargo right there. We did see that NXPI was down 5% as well, one of the big semiconductor companies out there. And then one of the large vaccine players, BioNTech, was down about 4.5% today. So I guess the takeaway here, can't really learn a whole lot from the selling side of the equation, but I think from the buying side of the equation, it was crystal clear. It was those Chinese stocks that really had a superior day. Let's go ahead and take a look at our normal charts here now. This is our 4 grid. And as you can see, this is chart 4B for those of you that are following along at home as premium members. And I just got done with some chart updates here earlier today. Some of you might have seen my tweet about that already or the Telegram, but just in case you didn't hear, charts 1A, 1B, 1C, and 1D were all updated here earlier today. So if you're a premium member, you can go and grab those importable shared links on the normal tutorials area of our website under our premium tools tab. Anyway, as we're looking at chart 4B here, this will give us a general sense as to what the intermediate postures are on these 4 key equity indices. And if the background color behind the current candle is green, that means we have a bullish posture. If it's pink, it means we have a bearish posture according to the market forecast technical indicator, specifically the intermediate line on that market forecast technical indicator. So as you can see here, the S&P 500 remains in a strongly bullish posture despite selling off just a touch today. It was down 0.13%. However, one thing to point out is that we did get what was known as a bullish intermediate confirmation signal today, as we have the green line in a bullish position in the upper reversal zone, and we have the red momentum line in the lower reversal zone. Now, as most of you are aware, there are additional ways to kind of determine whether those signals are less ideal or more ideal, and as it stands right now, I would consider this one to be a less ideal setup there from that particular perspective, because the blue line is still in the upper reversal zone as well. So remember that the bullish intermediate confirmation signal is supposed to be a buy the dips signal. And yes, it's true we dipped today, but let's be honest, we didn't dip very much, right? 0.13%. So if we would have dipped more, that blue line would have fallen further. And if we can find that blue line between 50 and 20, we're more interested in those particular setups. Like back here a couple of weeks ago, we had kind of one of those situations there. So anyway, just be aware that the signal exists, but not necessarily a great signal at this point. The main takeaway is we remain in a very strong uptrend for the markets, and people who have been denying this market for whatever reason, whether it's, hey, markets can't possibly go up 7 months in a row, or hey, these are the highest valuations we've seen in decades. Remember, the trend is your friend until the end, or until it bends. And right now it hasn't bent. You can predict all day long when you think it might happen, but remember, it's not up to you or me or any one of us individual traders. It's up to the market at large. And right now the market is telling you it wants to be bullish, and you're probably not doing so well to be fighting it, at least not aggressively, right? You can throw out a few bearish trades here and there and survive, but those that have been shorting this entire market for the last 7 months have to be in some extreme pain right now. Anyway, as we look at the Dow Jones Industrial Average, it was down 0.11% today. It also remains with a strongly bullish posture. As you can see, the background color of the chart is dark green. And in this case, I would say that the chart in the S&P 500 does look better from a trending perspective than the Dow Jones Industrial Average. You'll notice that the Dow Jones hit its all-time high back here on August 16th, so a couple of weeks ago, whereas the S&P 500 was just able to do that yesterday. So in this most recent bounce up and off the moving average here, it just hasn't been spirited enough to push us to new highs. We kind of have failed at some of that prior resistance area there. Now again, the pathway of least resistance continues to be the upside, because this moving average continues to be green, telling us that price is above a rising moving average. But it is something that we want to be on the lookout for, because we could very well be looking at this chart 3 weeks from right now and saying, yeah, see right there, it was a lower high from where it was right there. We can't make that claim yet because we don't have a lower low either. So right now we're kind of spiraling and tightening up here, and we're trying to figure out which way it wants to break. Is it going to break higher? Is it going to break lower? Path of least resistance tells us to the upside. Valuations could very well suggest that we need a breather, but a lot of this may be dictated by, of course, any eventual news that hits the wires here in coming weeks. So we'll keep our eye on that, but of the two, it does look like the S&P 500 is the stronger one. You can see down below here that the NASDAQ Composite also finished a touch lower today, but it did outperform the other two we've talked about thus far. It was only down 0.04%. You can see it barely budged here today. In fact, notice that the labels on all 4 of our charts are that blue color in the daily range, and what that's telling us is that today's range was small compared to the average true range of these securities here, or these indices. In other words, we didn't have a lot of volatility or a lot of movement here today as we closed out the month of August. It was a very quiet day. So we retain our strongly bullish posture on the NASDAQ composite. This has been a great place to be hanging out here, whether it's Apple or Microsoft or Alphabet. Those types of companies have continued to do quite well and continue to push the NASDAQ composite ever higher into record territory. So we just missed hitting a new record today. That still stands from yesterday, but we're just a hair off of it. So in other words, you could see that record broken as soon as the first 10 minutes of trading tomorrow if the market is up. So we'll keep our eye on that possibility, if not likelihood, because again, like the other two, path of least resistance continues to be to the upside. Now let's talk about the Russell 2000. As you can see, it was actually today's leader. It was up 0.34%, whereas the other three were down just a touch. But as we look at this chart compared to the other three, clearly the chart looks a lot different than the other three. This has been the one that has been the laggard over the last several months. In fact, as you look at these performance labels embedded within the charts here, you'll see that on a 3-month basis, which is the charts period that we're looking at right here, right? Each one of these charts that we're looking at are 3 months in length. Each one of the candles is 1 day. So that 3M 1 day, or 1D stands for that, 3 months, 1 day. So over this 3-month period, the Russell 2000 is actually still down. So despite outperforming today, it is losing investors money had they invested in the Russell 2000 exactly 3 months ago. Whereas if you had invested in some of these other areas, you're doing quite well. Take a look at the NASDAQ as an example, a stark contrast. The NASDAQ is up 11% in the last 3 months. This has been an impressive move for the NASDAQ. And remember, the summer months are traditionally pretty quiet. This has been a very solid summer for the tech stocks out there. So great to see a lot of those momentum stocks coming back. And we'll have that conversation tomorrow morning in my factor-based swing trading class, as that particular factor of momentum has really been coming to life the last several weeks. So anyway, the Russell 2000 does continue to try to play catch up with the other three, but you're just not quite there yet. You still have a long ways to go. You can see on this 3-month range, the high was way back here the first week or so of June. So several months ago, or 2.5 to 3 months ago that we saw that. But I don't want to unfairly paint the picture at the same time. And I will say that on the bullish side of the equation, it is a positive sign that the Russell 2000 is establishing a new range above its newly minted rising moving average. Notice the moving average here is green as well. For these other charts, the green moving average is not anything new. It's been green for most of the last 3 months. The Russell 2000, different story there. It just got a green moving average for the first time since going back here to basically right around July 4th. And so that is a positive sign. I would also say that it's positive that it is breaking out above this resistance area that we see on the Russell 2000 around 2250 or thereabouts. And we were able to break up and over that 2 sessions ago. And then yesterday was a little bit of a sell-off, and then today was a little bit of a pop back higher. But the fact that we're holding that range above the resistance, that is more promising than the way that this index looked just a couple of weeks ago when it looked like it was going to break down to further lows. So there are improvements here without a doubt, but we can also make the claim that this is still an underperforming security. It's the only one of these indices that's down over the last 3 months. Let's go ahead and take a look at our 3 green arrows chart. Oh, and by the way, before I leave this, I should mention as well, we do have a bullish intermediate confirmation signal here on the Russell 2000 as well. Notice the red line just barely got into the low reversal zone there. It ended right around 18, which is clearly below 20. So that signal exists on both the Russell 2000 and the S&P 500 at this moment in time, but because the blue lines are so high on each of them, neither one of those signals is considered ideal. Let's go ahead and take a look at our 3 green arrows chart now, which will be chart 4D. And as we're looking at this chart, you can see that we have a 3 green arrow signal on 3 out of the 4 charts in front of us. The only exception to that is the Dow Jones Industrial Average. As I mentioned before, that's the one that's kind of just been trading sideways here. over the last, let's call it week to week and a half. So it was not able to push up and through its highs from August 16th like the other three indices were. Now, just because the Russell 2000 was able to get up past where it was on August 16th doesn't mean that it's back to where it was here in June. But the point is, in the last couple of weeks, you have seen more strength out of the Russell 2000 than you've seen out of the Dow Jones Industrial Average, even though their charts do look quite a bit different at this point. So it just kind of feels like a bit of a stalling out there in the Dow Jones. Remember, that is a price-weighted index, and so the higher price securities there do have a bigger impact on that indice or that index compared to something like a market cap-weighted index like the S&P 500, which has been doing quite a bit better here in recent weeks. So 3 out of the 4 charts here do have that 3 green arrows signal, which is generally considered a positive sign for those of you that want to be bullish on this market here. All right, let's go ahead and take a peek over here at the internet. I always like to get a chance to say thank you to those of you that help support this particular project. When I presented the Amgen sold put opportunity there for you guys on Thursday, 105 of you did support the video on that particular day by clicking like for us there on Twitter. I should also mention, over here on the right-hand side, under our popular recent posts, you can see at this exact moment in time that the Thinkorswim chart links and setup tutorial is one of the items that's featured, as is the custom columns tutorial. Both of those are the 2 updates that I had mentioned earlier for those of you that are premium members. So nobody else except for our premium members has access to those. But if you are one of our premium members, then you do have the shared links within those 2 documents there to kind of set up this gradient feature, which is pretty neat. Mike Emerson helped me out with that. I appreciate that, Mike, if you're listening. And it kind of looks like this. You can kind of see the columns here. It's hard for me to click on it without it graying out, but you can kind of see it there where it kind of does an automated gradient feature based upon our WAR score system that we use, or weighted aggregate return score, which is a relative strength scoring method that's a proprietary method we use here at Market Scholars. And then also the gradient feature does work on something like the 30-day moving average column that we have there as well. So that is available for those of you that are premium members if you want to take advantage of that, as are the 4 new charts, 1A, 1B, 1C, and 1D that you can find here on the chart importation tutorial. Remember, I've tweeted them out, so if you didn't see my Telegram before, you can also find it on Twitter if you're looking for it there. Otherwise, remember, all of you premium members can always just find it here on the Premium Tools tab by hovering over that and then coming down to Premium Resources, and that's where you're going to find a lot of that content. So take advantage of that if you are a premium member. Also, let's go ahead and have a chat here about our sector selector. As you can see, healthcare did remain number 1 for the 2nd straight week. It's been kind of up there in the top 4 for basically the last 2.5 months, so it's not entirely surprising to see it kind of retain its strength up there. You did see a nice push out of both information technology and financials, and that was a healthy sign there, because remember, the previous week we saw that kind of quick little pop out of utilities, making you wonder, is this market going to get a little bit more defensive all of a sudden? But that was quickly thwarted, and some of those more cyclical areas were able to kind of regain their strength as we headed further on throughout that week. So anyway, maybe a more positive sign there for risk-taking measurement. Also, I should quickly mention I'm going to be taking a vacation day on Thursday. I'll still be in my class tomorrow for factor-based swing trading, but on Thursday I'm taking a vacation day, tacking it on to the long holiday weekend, trying to get out of town and relax a little bit. So that means there will not be a market outlook video on Thursday night. So I'll wish you guys a great holiday weekend here tonight, and I'll plan to be back with you a week from right now on Tuesday. So just wanted to make sure we're aware of that as well. And I won't be doing my question and answer session that I normally do for my premium students on Thursday either. But again, I'll be back with you guys tomorrow morning for those of you that want to get a little bit more education first thing tomorrow morning with factor-based swing trading. All right, let's go ahead and get back on over here to our charts, and let's do some 12 grid analysis. starting with chart 5A. This is our asset class 12 grid. And as you can see here, the background colors of these charts will tell us whether we have a bullish or bearish posture using that market forecast intermediate line. So the green charts are the bullish postures and the pink charts are the bearish postures. So as we're looking at this first set of 12 grids, as normal, we should look for some either trend continuations or reversals of note. And there's a couple things that catch my eye here today with these. First of all, high yield bonds is right on the verge of breaking out. Now this has been an extraordinary move for high yield bonds, from basically 3-month lows to 3-month highs in about a week and a half. So if this does break out above this prior high back here on July 7th, I just question how much more oomph it's got beyond that, because it's already exerted so much of an effort just to get back to the breakout area. Could it possibly go higher beyond that? Now obviously anything is possible, but we do have to try our best to have a certain assumption based upon historical precedent. And I would say in a situation like this, you better be a little bit cautious if your expectation is that we're going to break out here and then just continue to motor higher. This is one where it's made such a massive move here in such a short amount of time, it might very well need to take a little bit of a breather, even if it does end up breaking out tomorrow. So just be a little bit more cautious on that one. It's a little bit wide and loose type of a trading that we've seen there on high yield bonds. I do like what I see out of the Treasury yields down in the lower right-hand corner. You can see that we've made some progress on this chart in the last few weeks. In particular, notice that the moving average color is now green, telling us that price is back above a rising moving average. That's the first time since back here almost exactly 3 months ago at the beginning of June when you also had that feature, and then we went into this long downtrend. Well, now it's giving you the impression that maybe, just maybe, interest rates can start heading higher again. And that was part of what allowed the financials last week. So I don't know if you caught that when I was showing you the sector selector here a moment ago, but financials did make a nice little bounce from the number 5 position up to the number 3 position here last week on the sector selector. I think a lot of that is a result of interest rates going higher. Remember, the financials tend to do a little bit better when interest rates go up, whereas utilities and REITs struggle on a relative basis. So that is an important chart right there. And right now, I think my own mindset is leaning towards a legitimate reversal at hand, right? It's hard to reverse a chart, but this one appears to be giving it the old college try. And the fact that it's stayed above that moving average for as long as it has tells me that it means business. It's not just a fleeting circumstance. So keep your eye on that. If you do expect interest rates to continue to bounce higher going forward, then of course those financials might be an interesting place for you to look for bullish opportunities. Preferred stocks actually hit a new 3-month high here today, but strangely enough, they closed lower and ended up having a weekly bearish intermediate posture there. So some conflicting evidence, and that's maybe an example of a breakout that failed there. Now, this is just one day. Who knows? Maybe it kind of gets clicking again here tomorrow. But right now, that was maybe a little bit of a head fake where it broke out of that resistance area there on an intraday basis and then closed in the lower half of today's range. This is PFF that I'm looking at here, which tracks a preferred stock index. And so anyway, I like the trend of this. It's just that today's activity was a little bit strange, and you got to be a little bit leery of that type of a situation there, and that's kind of what that pink background color is telling us. You can see that the upward ascent in interest rates recently has applied some pressure to long-term U.S. government bonds. You can see that TLT is trading below its falling moving average here. And remember, that's kind of an inverse relationship to what we see with the Treasury yield chart that we see down below. So notice that we now have a red moving average on TLT for basically the first time since 3 months ago as well. So, if you do expect TNX to go higher, or interest rates in general to go higher, you're effectively saying that you expect TLT to go lower. And so you could always look for bearish trades on TLT. Otherwise, there are some inverse products. I think TBT is an inverse product. Let me just pull that up real quick. TBT kind of is designed to do the opposite of something like TLT. It does have a little leverage behind it, so you got to be more careful with those. But there are ways to kind of try to take advantage of that if you do assume that interest rates are going to continue to rise. Also, take a look at what happened to foreign bonds. Foreign bonds are breaking down even worse than what we're seeing with U.S. government bonds. Foreign bonds are basically at their lowest point since back here on July 16th, and that's a pretty clean break of that moving average. Notice that they also are trading below a falling moving average at this moment in time. Now, I mentioned before when we were going through the heat map that a lot of the Chinese stocks did really well today. So we shouldn't be surprised to see that EEM did lead from kind of a regional perspective, or a global perspective, I guess you could say. EEM, which tracks emerging market stocks, of which China is the most important country, it was up 1.37% today. Tremendously better than what we saw out of EFA, which was down 0.05% today, and then also SPY, which of course is the S&P 500 in the United States. It was down 0.15% today. So big day there for EEM, and that's some good progress. Now, as you can see, we're back up to these areas where we were trading on EEM back here at the end of July, beginning of August. So there might be a little bit of resistance there, but this has been a pretty impressive move that it's made after putting in that oversold cluster signal here on the 19th. So let's keep our eyes there, because obviously it's hard to find value opportunities out there, as the S&P 500 has just gone up for 7 straight months. One of the areas that has been left behind has been the emerging markets. So maybe, just maybe, there are some value opportunities that you could rotate into from the emerging markets perspective. Let's go ahead and take a look at our sectors. So this will be chart 5C, and these will be the U.S. market cap weighted sectors. And the only pink chart we've got on the board is utilities, but even utilities are above a rising moving average. All of the other charts have that dark green background color, telling us that we have a strongly bullish posture. Interesting couple of bounces that I would point out is down in the bottom rung. Take a look at consumer staples with that nice bounce up and off of that moving average. In fact, I'm pretty sure I referenced that possibility when I did the video for you on Thursday, to be on the lookout for that, because I still kind of like the way that the consumer staples chart was shaping up, and I like it even more now after having seen it go up for the last 3 days in a row. It's doing what I would have assumed that it was going to do at that time if I wanted to be bullish on it, which is to bounce off of that rising moving average. So I do like the activity that I see there on the staples. And then, wow, look at the real estate stocks. They've really been taking off here in the last 4 sessions or so. So real estate doesn't seem to have the same type of interest rate sensitivity that utilities do right now. Utilities have basically gone sideways for the last 4 days. Real estate, which oftentimes moves in unison with utilities, has decided to kind of dance to its own tune right now. And we've seen a really, really nice move there for real estate. Up and away. That's, I believe, all-time highs on XLRE, and a really nice bounce up and off of that rising moving average, similar to what we saw with staples, but with more authority, because we're off to the races with new highs there on real estate, which happens to be one of our biggest holding areas within our top-down trend trading class, where we've got 5 different REITs out of our 25 stock active portfolio right now. So we're cheerleading that move along. We'll see how long it lasts, but I do like that activity that we see there the last 4 days out of real estate. I also like what I see out of communications. I mentioned on Thursday that we were fortunate enough to double our money in Alphabet/Google, and that, of course, is one of the key communications companies out there. I would also point out that Facebook is starting to come to life a little bit again after kind of disappointing folks after their recent earnings announcement. So a couple of those big-time players there in the communication space helping to push XLC to new all-time highs here all of a sudden again. Be aware that we did get an overbought cluster signal yesterday on the technology sector, and technology was down 0.53% today, and that was second to only energy in terms of the worst performer of the day. So maybe a little bit too hot to the upside there on technology. Today was a little bit of a cooling off day for that sector. All right, let's go ahead and get into our trade application example now. And for that, I'm going to pull up our swing trading chart, which is chart 3A. And I want to pull up ticker symbol IWM, of course, one that most of you are quite familiar with. This is the ETF that tracks the Russell 2000, aka the small cap index. And as you can see, today we did have an up day for IWM. It was up 0.20%, but it wasn't enough to continue the momentum that IWM has seen in the last couple of weeks. You can see that the background color of the chart changed from blue, light blue, to this light pink color. And what that is letting us know is that the blue line is no longer considered bullish. Today you can see the blue line rolled over and fell out of the upper reversal zone. So it's at 77 and falling at this moment in time. So we would consider that near-term posture to be bearish, even though the intermediate posture continues to be bullish. Now, the reason that I wanted to look at this one a little bit more closely for our bearish trade idea today was because it also is an example of what's known as a bearish near-term divergence. And what I was kind of identifying with that signal is looking at this high that we saw here established for the near-term line, where it peaked out here at around 97, and then this follow-up peak that occurred here on August 30th, where it peaked out at about 83. So in other words, we saw a lower high in the underlying indicator. Now, the candles associated with those two moments in time, the price candles, were this candle right here and this candle right here. So in other words, price candles went up at the same time that the underlying indicator was deteriorating. So we have opposing thoughts there. And so that's what's known as a bearish near-term divergence that I wanted to test out. It hasn't really played out tremendously yet. Obviously, it's had an update today, but at least provides an excuse for me to put on a somewhat rare bearish trade. As you are aware, we have mostly bullish trades in my trade application examples here more recently. The exception of that would have been that Delta Airlines trade that I did here a week or two ago. But otherwise, it's pretty much all bullish trades. So I'm kind of looking for an excuse to put on some bearish trades here or there, just to kind of balance things out a little bit more. And this is as good as an excuse as any, I suppose. And so what I ended up doing was selling in October, I believe it was the 236, 237 bear call spread. And so that would put our break even somewhere up in this general vicinity here. And you'll notice at that particular level, it is higher than where IWM was trading back in the first week of June. So in other words, in order for my trade to be threatened, it would have to break out to new all-time highs. Now, obviously, that's entirely possible. That could happen. But given the fact that I've got so many bullish trades in my portfolio right now, it wouldn't be the end of the world for me. It wouldn't break my heart if that's what was in store. On the other hand, if it does kind of stall out here after making such a big move off of this double bottom here and starts kind of traveling a bit sideways, or even continues to go up but just kind of moderates its pace and goes up more slowly than it has over the last week and a half, then we should be in reasonably good shape with that trade. Obviously, if it rolls over and goes bearish, even better. But the main thing is, for those of you that are newer to selling bear call spreads, is we don't want our break-even price breached on expiration date, in this case, in the month of October. So it's about 45 days or whatever it is. Remember, you can get all the trade details, including the execution prices. We always shoot for about a 30% return on risk on these types of credit spreads, and the strike prices, the dates, and all that kind of stuff on our Telegram app if you are a premium member. Remember, I do these trades during the trading day to give those of you that are premium members of Market Scholars an opportunity to consider the trades before everybody else who's watching the free video that night can. So nice little perk for those of you that are our premium members there. So that's kind of what I had for you here today. A bit of a balancing act there of sorts to add a little bit more bearish exposure into my currently very bullish portfolio, and doing it using the excuse of the bearish near-term divergence that we've spotted here using that near-term line on that market forecast technical indicator. So if you got value out of tonight's video, I would encourage you to click like for me there on Twitter. Again, a reminder, I'm not going to be with you on Thursday as I'm taking a day off there, but I will plan to be back next week. So I'll look forward to seeing y'all at that time. And I'll see all of you premium members tomorrow morning in my factor-based swing trading class. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.